All right, today we are diving deep into one of the most important metrics on any income statement, the cost of goods sold, or COGS. Now, for any business selling a physical product, getting a handle on COGS isn't just some accounting chore, it's a massive strategic lever. If you really understand it, you can see the true efficiency and profitability of a company.
So here's our game plan. We're going to start with the basics, what COGS actually is and how it's calculated. Then we'll peel back the layers and look at the accounting choices that can totally change the final number. From there, we'll get into the strategic side of things and, maybe most importantly, what red flags to watch out for.
So first things first, let's build our foundation. What exactly are we talking about when we say COGS, and why is it so fundamental to a company's profitability?
This quote from Investopedia just cuts right to the chase. It's so direct. The less it costs you to make what you sell, the more money you keep from every single sale. It really is that simple and that powerful.
Okay, let's put a formal definition on that. COGS covers only the direct costs of getting a product ready to sell. Think raw materials, the components, the wages for the people on the factory floor. The whole point here is to isolate how efficient the production process is. That's why we deliberately leave out indirect costs like marketing or the rent for the head office. Those are part of a whole other bucket of expenses.
So let's just lock in these key takeaways. Number 1, COGS is all about direct costs, nothing else. Number 2, it's the very first thing you subtract from your revenue to figure out your gross profit. And number 3, and this is a huge point we're about to get into, it is not some fixed objective number. The way you do your accounting can completely change it.
So how do companies actually come up with this number? Let's unpack the formula they use to get to that final COGS figure on the income statement.
The best way to think about this formula is as a flow of inventory costs. You start with whatever you had left over from last year. Then you add in the cost of everything new you bought or made this year. That total gives you the cost of all the stuff you could have sold. So if you just subtract the value of what you didn't sell, what's left on the shelves, what remains is, logically, the cost of what you did sell.
And that right there is the most important concept to grasp. The final number isn't the cost of everything you made this year. Nope, it's only the cost of the products that customers actually paid for and took home. The cost of all that unsold stuff, it just sits on the balance sheet as an asset waiting to be sold next year. Okay, this brings us to a really crucial point. That COGS number isn't some absolute truth written in stone. It's actually the result of a specific accounting choice, and depending on which method a company picks, it can seriously change their reported profits, especially when prices are going up.
This is where strategy really comes into play. So let's say inflation is high. If you use FIFO, first in, first out, you're matching your older, cheaper inventory costs against today's high sales prices. The result? A lower COGS and higher profits, which looks great to investors. But if you use LIFO, last in, first out, you match your newest, most expensive inventory against your revenue. That means a higher COGS, which makes your profits look lower. But, and this is key, it also lowers your tax bill. The average cost method just smooths everything out. The choice is a very deliberate one.
And just to be thorough, there's a fourth method, but it's for very specific cases. If you're selling something unique and expensive, like a specific car or a one-of-a-kind diamond, you don't have to assume anything. You can track the exact cost of that specific item when it's sold.
Okay, so we know what COGS is and how to calculate it. Now we need to draw some really clear lines around it. What's in and what's out. This is where that consultant mindset of being mutually exclusive and collectively exhaustive really helps.
The main boundary is between COGS and operating expenses, or OPEX. The easiest way to think about it is this. COGS are the variable costs. If you make more stuff, these costs go up. More cars require more steel. OPEX, on the other hand, are the more fixed, indirect costs of just keeping the lights on. Things like the marketing budget, the CEO's salary, or the office rent. You have to pay those whether you produce one item or a million.
So here's a fantastic rule of thumb if you're ever trying to decide where a cost belongs. Just ask yourself this one simple question. Would this expense still be here if we made 0 sales this month? If the answer is yes, like your office rent, then it's an operating expense. If the answer is no, like the cost of raw materials for a product you never made, then it's tied to COGS.
And it's really important to remember this whole concept is for companies that sell physical things. A service business like a law firm or a consulting group like ours doesn't have inventory, so they don't really have COGS. Instead, you'll see something like a cost of services or cost of revenue, which is usually just the salaries of the people providing that service.
Okay, we have definitely covered the nuts and bolts, so let's shift gears and talk strategy. Why does this one number matter so much to managers, to analysts, to literally everyone watching a company?
So let's just trace it through. How does this line item on a spreadsheet actually flow all the way down to a company's profit? Well, the connection is about as direct as it gets.
It's the very first calculation on the road to net income. You take your total sales, subtract the cost of making the goods you sold, and what's left is your gross profit. This isn't just an accounting step, it's a raw measure of your company's core profitability. Every single dollar you can save in COGS is a dollar that drops straight into that gross profit line.
So you have this really fascinating tension, this strategic push and pull. On one hand, managers are always trying to drive COGS down, negotiating with suppliers, making the factory more efficient, because that makes profits look better for shareholders. But on the other hand, remember LIFO? A company might actually choose an accounting method that gives them a higher COGS, because while it makes their profit look smaller, it also means they pay less in taxes. It's a constant balancing act.
And that brings us to our final, and maybe the most critical section. Because COGS is so powerful, it's also a place where companies can play games. So as an investor and analyst, what do you need to be looking for? Look, when a company wants to pretty up its earnings, COGS is a prime target. The tricks can be subtle, but they're incredibly effective. Things like overstating the value of their leftover inventory, or forgetting to write off a bunch of stuff that's now obsolete. Each one of these moves artificially pushes COGS down and creates a phantom profit that isn't real.
So how can you spot this from the outside? Here is a huge red flag for anyone doing analysis. If you look at a company's financials and you see their inventory number on the balance sheet is growing way faster than their sales are, you need to be very careful. It could just mean they're not selling products, or it could be a sign that they're hiding costs in that bloated inventory number to make their COGS look better than it really is.
So I'll leave you with this final thought. COGS is so much more than a line item. It tells a story about a company's efficiency, its strategy, and sometimes even its integrity. So the next time you see a company post some amazing profit numbers, ask yourself, does their cost of goods sold tell the real story?